learners. Welcome to the course on agricultural economics. Today we are going to discuss about measures for reducing risks and uncertainty in agriculture. One of the most critical and intrinsic decisions for agricultural producer involves selecting the optimal combinations of risks and risk management strategies to safeguard their income effectively. The management of risks and uncertainty in agriculture is not only pivotal for the farming sector but also has broader implications for the overall economy. Farmers have access to a range of risk management tools designed to help them mitigate, prevent, share, transfer, diversify, or assume risks. The choice of a specific tool depends on individual circumstance of the farmer and their willingness to bear risks. Risk management strategy aim to provide protection in situations where the outcome of decisions are uncertain. These strategies encompass various measures that can either reduce the likelihood of unfavorable events occurring or minimizing the adverse consequence if such events do occur. However, it is important to note that mitigating risks often involve sacrificing some potential gains. In essence, most responses to risks carry a cost, whether it is explicitly monetary or in terms of missed opportunity. Farmers generally seek to avoid significant losses while also positioning themselves to capitalize on favorable events. Therefore, the goal is to manage risks in a way that maximizes protection without excessively sacrifice potential profit. The initial step in this process involve identify effective strategy for coping with risks and selecting method to mitigate, transfer or accept business and fundamental financial risks. A comprehensive understanding of this strategy enables grower to effectively reduce uncertainty and enhance profitability. Firstly, that is the measures to reduce production risks. Number one, selections of less risky enterprise. Choosing a less risky agricultural enterprise involves assessing and understanding the varying degrees and types of risks associated with different farming activities. For instance, crops with longer gestation period like fruits carry higher risks because their probability can be affected by fluctuation in the value of money over time, which reduce the real value of net return. Additionally, perishable nature and high resource requirement make vegetable crops risky, as prices can fluctuate significantly and necessarily resources may not always be available when needed. On the other hand, crops such as wheat and paddy are considerably less risky due to their relatively stable yields, and the support provided by the government through mechanisms like minimum support prices. However, these crops are still vulnerable to weather-related risks such as flood or drought, which can adversely affect production. The nature and extent of risks vary widely across different agricultural enterprises. Farmers must evaluate their own risk tolerance and capacity to manage these risks effectively when making decisions about which crops to cultivate. This decision-making process involves weighing the potential benefits against the risks associated with each type of crop or enterprise. Therefore, the selection of a less risky agricultural enterprise involves a careful assessment of the specific risks involved in different types of farming activities. farmer must consider factors such as market volatility, resource availability, government support, and environmental risks when determining which crops or enterprise align best with their risk tolerance and financial goal. By choosing enterprise that match their risk capacity, farmers can enhance their chances of achieving stable and sustainable agricultural production. Number B, adopting production method with low variability. Choosing production method that exhibit minimal variability can significantly reduce fluctuation in returns. For instance, opting for labor-intensive land preparation over using a tractor is a less risky approach. Similarly, selling produce immediately after harvest rather than storing it for extended period tends to be less risky in terms of price fluctuation. The key to adopting low variability production method lies in selecting practice that offer greater stability in outcomes. For example, relying on consistent and available human labor for tasks like land preparation can mitigate uncertainties associated with machinery availability and operational cost. Likewise, promoting selling harvesting crops, minimizing exposure to market volatility that could lead to unpredictable price changes over time. In essence, the strategy involved choosing production methods that prioritize stability and predictability in returns. This approach helps farmers mitigate the inherent risks associated with agricultural production and optimize their chances of achieving consistent profitability. Number C, insurance. Insurance play a crucial role in mitigating various risks associated with farming, including both production and financial risks. Crop insurance schemes are designed specifically to reduce production risks for farmers. These schemes provide compensation in case of crop failure due to adverse weather conditions, pests, or other covered events, thereby stabilizing farm incomes and protecting against potential losses. Livestock insurance is another important type of insurance that safeguards farmers against financial losses resulting from fatal disease or accidental affecting their cattle. By covering veterinary expenses or providing compensation for the loss of livestock, this insurance helps farmers manage risks related to animal health and productivity. Furthermore, farm assets such as farm building machinery like tractors and power tiller can also be insured against the various risks such as thief, burglary, fire, or damage caused by natural disasters. Insuring these assets ensure that farmers are financially protected in case of unforeseen event that could otherwise lead to significant financial setback. Overall, insurance in farming serve as a critical risk management tool by providing financial security and stability to farmers. It allows them to mitigate the uncertainty inherent in agricultural production and operation, thereby enabling them to focus on sustainable farming practices and enhancing overall farm resilience. By choosing appropriate insurance coverage tailored to their specific needs, farmers can effectively safeguard their investment, ensure continuity in farm operation, and protect their livestock against unexpected challenges. But the diversifications of enterprise. Diversifications of enterprise in farming refers to managing a wide variety of agricultural activities within a single farm operation, which serves to mitigate risks effectively. For example, a farmer who allocate portions of their land to rice, maize, and the various vegetable crops face lower risks compared to solely cultivated any one of these crops. Vegetables such as cauliflower, cabbage, carrot, and chili tend to riskier due to their susceptibility to yield fluctuations and price volatility. Therefore, integrating these crops with others can significantly reduce overall risk exposure for farmer. Additionally, integrating non-crop allied enterprise like dairy farming, poultry, fishery, and mushroom cultivation alongside crop production can further enhance risk reduction strategy. These diverse activities provide alternative income stream and reduce dependence on any single enterprise, thereby spreading risks across multiple sectors. In essence, diversifying agricultural enterprise allow farmers to manage and minimize various risks associated with crop production. By combining different crops and integrating allied enterprise, farmers can achieve a more balanced risk profile, ensuring greater stability and resilience in their farming operation. This approach not only helps in stabilizing income but also contribute to sustainable agricultural practice by promoting biodiversity and enhancing overall farm sustainability. Agronomy practice. Various agronomic practices include crop rotation, the choice of appropriate crop variety such as flood tolerance, rice varieties, and disease resilience strain, implementations of deep tillage operation, and the use of mulching are essential for mitigating production risks. Number asset structure. Asset structure refers to the compositions of a farmer's owned resources, which play a critical role in managing financial risks effectively. Assets can encompass various forms such as cash, crop yields, machinery, livestock, tractors, building, and land. The liquidity of asset is a key factor in mitigating financial risks, as liquid assets can be readily converted into cash within a short time frame, typically within 1 year. Example of liquid assets include cash on land, fund deposited in bank, and farm produce that is ready for immediate sale or disposal. For instance, maintaining a higher proportion of liquid assets provides farmer with quick access to fund in case of unforeseen expenses or financial emergencies. This liquidity helps mitigate the risks of liquidity shortage or the need to liquidate assets at unfavorable times or prices. Conversely, certain assets such as a pair of bullocks are considered less liquid compared to machinery, like tractors. While the bullocks may have productive value in farming operation, their ability to be quickly converted into cash is limited, thus potentially increasing financial risks. Therefore, the compositions and liquidity of assets are crucial consideration for farmers in assessing and managing financial risks. By maintaining a balanced asset structure with adequate liquid assets, farmer can enhance their financial resilience and ability to navigate uncertainty in agricultural production and market conditions effectively. This strategy approach not only safeguards against unexpected financial setback but also support sustainable farm management by ensuring the availability of resources needed for ongoing operation and investments. Next, flexible production plan. Flexible production plans involves making adjustment to minimize risks and uncertainty in agricultural operation. For instance, during the wheat sowing season, if continuous rainfall threatens to delay planting, it may be prudent to switch to an alternative crop like sunflower rather than risking reduced yield due to the late planting. This adaptive approach helps mitigate the risk of yield losses caused by adverse weather conditions. Similarly, allocating scarce resources such as labor based on the potential risks and returns of different crops is another effective strategy. For example, if cauliflower offered higher profitability compared to wheat and there is a limited workforce availability, periodizing labor for cauliflower cultivation can optimize return while managing resource constraint. Next, there is a market risk management. If commodity prices exhibited higher degree of fluctuation, the resulting market-based price risks increase. Various methods can be employed to mitigate this marketing risk. Number one, selling the farm products at different point of time. Selling farm product immediately after harvest due to financial pressure often reduced in distressed sale, where prices are typically low due to high market supply. Avoiding such sales allow farmers to potentially pay better prices for their produce. To achieve this, farmers need to be well informed about market dynamics, including the balance between supply and demand and the price trends of agricultural products. Furthermore, having reliable storage facilities is essential. Three facilities enable farmers to store their produce post-harvest, waiting for market condition to improve before selling. Good processing facility also play a crucial role as they allow farmers to add value to their product, potentially fitting higher prices in the market. In essence, strategy timing of sales supported by market knowledge and access to appropriate storage and processing infrastructure can help farmers maximize their income from agricultural produce. By avoiding distressed sales and leveraging favorable market conditions, farmers can enhance their profitability and financial stability in the agricultural sector. Next, government price policies and programs. Government employ a range of price policies and programs aimed at stabilizing agricultural commodity prices. These measures include minimum support price (MSP), pro-current prices, levy prices, and issue prices. Each policy serves a distinct purpose in regulating market price to ensure fair returns for farmers and stability in agricultural markets. The minimum support price (MSP) is a crucial policy tool that provides a price floor for certain agricultural commodity. It is set by the government to safeguard farmers from abrupt decline in the market price, ensuring they receive a minimum guarantee price for their produce. This mechanism helps farmers manage price volatility and economic uncertainty associated with agricultural production. In addition to MSP, pro-current price policy involve direct government purchase of agricultural commodity at predetermined prices. These interventions stabilize market prices by reducing surplus supply and supporting farmers during periods of market downturns. Levy price policy impose duties or tariff on agricultural imports to protect domestic farmers from competitions with cheaper imported goods. These measures aim to maintain price level that support local agricultural production and farmers' income. Furthermore, issue price policy regulated the sale prices of essential commodity to consumer, ensuring affordability and stability in the retail market. By managing both producers and consumer prices, governments can achieve price stabilization across the agricultural supply chain. Overall, these government price policy and programs play a crucial role in mitigating risks for farmers, promoting agricultural sustainability, and ensure food security. By providing price stability and income security through mechanisms like MSP, the government support farmer in facing market uncertainty and achieving sustainable agricultural development. Next, financial risks. Within financial risks, it's involving different measures. Number one, keeping farm record. Keeping through farm records play a pivotal role in helping farmers manage and reduce financial risks. By maintaining accurate record, farmers gain visibility into their financial status at different points in time. This includes understanding where they have been financially, their current financial standing, and whether they are moving toward their financial objective. Good farm records also provide farmers with insight into their financial risks. By analyzing balance sheet, income statement, and cash flow statement, farmer can pinpoint areas of financial vulnerability and areas where improvements are needed. This allows them to proactively address financial challenges and make strategy adjustment to their operation. Moreover, these records serve as a foundation for evaluating financial performance. Farmer can trends, identify pattern, and assess the effectiveness of their financial strategy over time. This informed analysis helps farmer make sound financial decisions that support the overall profitability and stability of their farming enterprise. In essence, maintaining comprehensive farm record is not just about record keeping, it is a strategic tool for risk management and financial planning. By leveraging this record, farmer can minimize financial uncertainties, optimizing resource allocations, and position their operations for long-term success. This proactive approach to financial management ultimately strengthens the resilience and profitability of agricultural enterprise in an increasingly complex economic environment. Number two, smart loan. Maintaining financial risks associated with loans involves strategic decision making regarding interest rate structure and loan repayment mechanism. Opting for a fixed interest rate provides borrowers with certainty, as the interest rate remain unchanged over the loan's lifespan. This stability shields borrower from potential increase in interest rates, which could otherwise escalate loan repayment costs and strain financial budget. Although fixed interest rate may initially appear higher compared to variable rates, they offer peace of mind by ensuring predictable loan expenses. Self-liquidity loan offer another layer of risk management. These loans are structured to align repayment with the income generated from the financial asset. For instance, loans for crop production are settled with revenue from crop sales, while loans for livestock such as dairy cows or feeder cattle are repaid through earning from milk or cattle sales, respectively. This approach reduces the burden on the borrower cash flow by leveraging the productivity of the financial asset to cover loan obligations. Thus, selecting fixed interest rates and utilizing self-liquidity loans are prudent strategy for farmer and business to mitigate financial risks associated with borrowing. This approach provides stability, predictability, and alignment between loan repayment and revenue generation, thereby enhancing financial resilience and supporting sustainable growth in agricultural enterprise. By effectively managing loan structure and repayment mechanism, borrower can navigate economic uncertainty more confidently and optimize their financial resources for long-term success. Next, reserves. Maintaining liquid reserves such as cash or easily convertible assets is crucial for farmers to mitigate financial risks effectively. These reserves act as a safety net, providing immediate access to funds in emerging or even unexpected expenses arise. By having liquid assets readily available, farmer can manage cash flow disruptions, cover essential expenses, and avoid financial distress. Similarly, leveraging in credit reserve offered by financial institutions enhance financial resilience. Farmers often establish credit lines within bank or lenders, borrowing conservatively below their credit limit. This approach ensures that additional funds can be accessed promptly if required to sustain farm operation during challenging financial circumstances. This credit reserve provides flexibility and security, enabling farmers to address unforeseen expenses or capitalizing on businesses opportunity without disrupting cash flow. In essence, maintaining both liquid and credit reserves is a proactive strategy for farmers to protect against financial risks and uncertainty. Liquid reserves provide immediate financial support in the times of need, while credit reserves offer access to supplement funds for ongoing operational needs. By strategically managing reserves, farmers can strengthen their financial position, mitigate potential disruptions, and enhance their ability to withstand economic fluctuations in the agricultural sector. Next, renting or leasing. Renting or leasing land and machinery offer farmers a practical approach to reducing financial risks in their operation. When farmers choose to rent or lease land instead of purchasing it, they avoid taking on the substantial financial commitment and potential debt associated with securing a land loan. This flexibility allows them to allocate resources more efficiently and adapt to changing economic conditions without the long-term financial liability of land ownership. Likewise, opting to rent or lease equipment provides several advantages in risk management. By leasing equipment, farmers can operate without the need to finance costly equipment purchased through loans. This approach conserves capital and preserves financial liquidity, which is crucial for managing cash flow and responding to unforeseen expenses or market fluctuation. Furthermore, leasing newer or more reliable equipment offer additional benefits in risk reduction. Modern equipment is less prone to breakdown and operational failure, thereby minimizing production disruptions and the associated financial losses. Farmers can avoid the expenses and downtime associated with repair, ensuring the consistent productivity and operational efficiency throughout their agricultural activity. In a nutshell, renting or leasing land and machinery represent a strategic approach for farmers to mitigate financial risks and enhancing operational flexibility. By opting for rental or leasing agreement, farmers reduce their exposure to large loan and maintaining costs, while maintaining access to essential resources for agricultural production. This approach supports prudent financial management, improve risk resilience, and enable farmers to optimize their resources effectively in dynamic agricultural environment. Thank you.